Time now for Smart Charts with Abigail Doolittle, where we take a look at a timely topic through the charts with some of the street's top technicians. And Abigail, you're going to commodity heavy today, is that it?
You're right about that, Romaine. We're actually not going to be looking at that ISM number in stocks, but we're going to be looking at gold, which could be one way that you'd want to play a potential downturn in manufacturing, along with oil. To do this with me, I have John Gagliardi of Fidelity Investments. Thanks so much for joining me, John. And yes, let's avoid ISM and all of this drama that we've had on the day and take a look at gold, but that could be a good haven to play against any sort of potential recession and or correction in stocks. And you have a chart that you brought with you back in June, and it has not changed except for the fact that you got the breakout you wanted.
Yes. So last time I was here, we were talking about how gold is one of these great things for technicals. It does everything that you want. And it's so clear to see. You had expansion, peak, recession, and this long, dreaded trough, which kept going and going. And we were here right around this spot in June when we were focusing on gold. We were saying, look, this could break either way. And I got a little bit beat up on the Twitter sphere and YouTube comments, and people were saying, well, which way is it going? The thing is, technicals, it's not about predicting. I'm not a fan of the predicting business, but what I like is I like being in the fact business, in the this is obvious business. And if you have an entry here and this is your stop, this looked like a decent setup for a trade, which can then turn into a long-term investment.
So this is on the GLD, and I also see that you have a MACD that was looking pretty positive. I could actually start, so it looks like it's starting to go down into a sell signal, and then that's volume. But talk to us about how that helps frame your bullish call.
Yeah, so when you see MACD is kind of wound up in this very, very tight space, it wanted to break one way or another, and in this case, of course, it broke up. And now we've got a pullback, so now we've got a confirmed uptrend. And in any confirmed uptrend, any buyback is a buyable event on any pullback. So now that we have a pullback going on, the question is, where should you get in? And this is a tough one. The further down it goes, the better the risk reward. However, you might not get on board. So you might miss it while you're waiting for it to come in. And I tell my clients all the time, it doesn't have to be guardrail to guardrail, either all in or all out. You could always leg in on the way down.
If below that support level, though, that used to be resistance, that would probably be bearish, though, right?
You know, it's funny with the machine trading today, I really like to stick to the very, very basics that if this low is the low and this is the uptrend, I'd be looking for these areas for support.
So you'd be looking for that uptrend. That's pretty bold. You have to have a stomach, not of steel, of gold to handle that on the downside. Now let's take a look at oil, because it's kind of interesting. You have this haven commodity. You think it's going higher. And then you also have this growth commodity, oil, real tell on the global economic picture, also going higher.
And it's the same kind of thing, right? We never know for sure. But you have to look at the weight of evidence. So if you look back here, 2015, 2016, oil was breaking down pretty hard. And you can see this huge decline here from one low to the next. We have a decline that's pretty heavy. But while we're looking at that, you have to keep your eye on your other indicators. And you can see a very steady rise in relative strength. So you've got this massive divergence in relative strength. And how did that work out? Well, we had a 100% rise in the price of, this is the oil drillers. So in this particular ETF, XOP, we had 100% return. Now, this could be seen from a trader's point of view as mean reversion, or it could be seen as what might wind up becoming a longer-term investment if it worked out. It didn't really work out, because here we are again, right back at the same lows. But interestingly, we're seeing the same divergence. Now, does that guarantee anything? There are no guarantees on Wall Street.
Right. So, but for the near term, you're potentially bullish on oil, the drillers, the entire space. I have to believe, though, that if you think that oil and gold are going higher, you think the dollar is going lower?
It could be a weird divergence where we see something that's out of the ordinary, but this would definitely be a whole late stage cycle where all commodities are supposed to do well in late stage.